Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to Pasture to Pen, a new series from the Ever.Ag Insights team. Each week, we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen, coming to you live from my home office in the Texas Panhandle. Before we get rolling, I will timestamp this episode. Today is Wednesday, July 12th, 2023 at 2:04 in the afternoon. Today, I am once again joined by my co-host and teammate, Mr. Trey Freeman. On this episode, Trey and I will be welcoming the king of feed and Ever.Ag's director of feed procurement, Mr. Jake Kingsley. Gentlemen, welcome to the show.
Thank you, Michael. How are you today?
Doing well, gentlemen. Mr. Freeman, if you will kick us off with a futures update, please, sir.
You bet. New contract highs were posted again this morning in fat and feeder cattle futures. However, with both finishing lower on the day. At one point, August feeders were up over $4 a hundredweight on the day, but finished 50 cents in the red. August fats had similar action, finishing $1.95 lower at 176.87 with a daily range of 465. The boost this morning was sparked by sharply lower grain futures following the USDA's WASDE report and appeared to be accentuated by some stops being hit just above contract highs. Ultimately, cattle were reaching overbought territory, and once grains found some footing into the afternoon, traders began taking profits. The spike higher followed by a lower close. It's not a good look on the charts, but on a positive note, we did hold yesterday's lows. Now, overall, today's volatile action, it's not all that out of line with what we've seen since the beginning of June. Wide ranges, they're expected as we continue to expand into new high territory, and this has certainly been true for feeders due to the wild weather markets and grain futures over the last 6 weeks. But bottom line is emotions are heightened at these record high prices, and this will go hand in hand with volatility.
Awesome. Thank you very much, Trey. In the cash market, last week presented limited activity out of the sale barns as far as for feeder cattle and calves. The Independence Day holiday fell on a Tuesday, so most barns closed their doors on Monday and Wednesday. When auctions reopened late last week, prices sparked a little bit higher. This caused a $7.45 jump in the 7-day average of the CME Feeder Cattle Index as of Friday, July 7th. As we move through a full week of scheduled sales, prices continue to move higher on the feeder cattle front. For live cash cattle, the trend of high prices continues to hold true. Last week, cattle traded at 178 live in the south and 185 live in the north, with producers being very stubborn about receiving those prices, especially prices above futures. Iowa traded cattle yesterday at 184 live. As we move into the summer, past our peak demand season for beef, naturally, we are seeing cutout values decline. Yesterday, the cutout closed at 312.12 for choice and 280.24 for select. Just as we saw earlier in the spring, retailers are starting to gravitate back towards the blend of select cuts to boost their margins, passing on the higher price choice cuts. This is putting the packer in a pretty tricky spot. This is more of a case that retailers aren't buying as much choice grade meat, but are still expecting their contracted supply of choice grade meat. This means the packer still has to go find choice grade cattle to fulfill their contracts. However, those cattle are not easy to find in the summer heat and are not easy to find given our supply crunch. Feed yards know this better than anyone. They continue to draw a line in the sand on price, making it the packer's equation to simply figure it out. As we have said before, no cattle, no packer. Looking at pasture conditions and weather, 47% of the lower 48 states have good to excellent pasture conditions. This is a 3% improvement week over week and an almost 20% improvement year over year. As we all know, last year, very drought-ridden over most of the United States, especially cattle country. Most of the cattle country's pasture conditions is sitting at this percentage for good to excellent pasture conditions, with a couple exceptions. Weather-wise, a decent portion of the country has been experiencing rainfall from the plains all the way over to the Corn Belt. However, the most talked about rainfall has been in the Corn Belt. Before these rains, it has been uncharacteristically dry, especially in the I states. And here to talk to us today about rain in the Corn Belt and its effect on the markets is Jake Kingsley. Jake.
Sure thing. Yeah. I mean, as most already know, this time of year is a pretty standard weather market for grains and feed commodities. It's just the growing season for our major corn and bean and wheat crops here. The difference this year was the excitement of having a exceptionally dry June, as you had mentioned, across the I states in the heart of the Corn Belt. And so that had everybody on their toes a little bit, concerned if we were going to catch anything at all and what that's going to do to yields. Now, I will say we have not had a test of crop genetics like this in a decade. I would maybe even argue ever, because when we did this last time in 2012, we killed the crop. There's still pretty good hope that we've got a decent yield out there. So we're going to need some pretty timely rains over the next 60 days here to get through July and August and really set some yields into the fields out there. But we're on the right track now. Outside of weather, we've had a lot of reports come in through June and now in the middle of July to throw a little more volatility into the market. So we ended June with the acreage report on the 30th, where we took bean acres down about 4 million acres from about 87.5 down to 84 million or so. And corn acres went up 2 million on that report. So there was quite a bit of volatility there on the 30th of June. Added a little bit of cushion to the corn balance sheet, made the already thin bean balance sheet skinnier yet. And then we had today's WASDE report come in and trim corn yields down to 177.5 bushels and leave beans at 52 even. So we're starting to see trim up on corn yield, which was expected, but we took down old crop exports and, of course, added all those acres to kind of make it a more muted effect on the net ending stocks there and continue this bearish tone in the corn market as we saw reflected in futures today. Soybeans cooled off a little bit finally and meal as well, with yield staying put and rain continuing to start to move its way across the Midwest there. So we saw that reflected in futures as well, with a nice turn lower after a pretty strong start to the day and a strong start to the week. Protein values have come off a little bit. Now we're seeing a little bit of a different story shape up in the basis part of that deal. Corn basis has continued to drift lower, especially in the western half of the U.S., the rail-dependent markets there, as the plain states catch some rains and get back to somewhat of a normal production year after last year's pretty devastating drought there in Kansas and Nebraska and the Dakotas. So we're seeing those numbers drift lower. Soybean meal, canola, other related proteins, basis had bottomed out back in early June or so and has actually ticked back higher, $5 or $10 depending on where you are in the country. But seems like if we can produce the crop that we're talking about, maybe we'll have some opportunity for some softness in those yet. With all of this movement, everybody's kind of asking, okay, what do we do now? How do we feed these animals? And I think it's okay to step in and on a dip here and price some protein maybe for the October to March timeframe. Keep it in a little bit of a shorter contract window because we will add a little bit of crush capacity. And of course, February and March tend to be the time when South America goes to harvest their crops. So that could help us out price-wise if they can put together some nice production down there this coming spring. Corn markets feel like they've got a fair bit of softness left in them. So we're not out here jumping up and down telling folks you got to get it all bought today, but it's definitely a nice place to get started where we're at better values than we'd had in the last 18 months or 2 years. So it's a good place to get started. But if you feel you want to be a little patient there, we think that's all right to do as well. If anything, just create some flexibility in your marketing plan, right? This is could be a turning point in a 3-year cycle now, and you don't want to be stuck with high prices on feed as your revenue sources start to decrease their value.
Thank you very much, Jake, for that insight. That is a wrap for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you haven't done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. Thank you once again to my co-host and teammate, Trey Freeman. Thank you again to Jake for joining us on this episode. As always, a big thank you to Paige, who always helps us look our best. A big thank you and a big welcome to our newest team member, Hattie. Thank you also for being on this episode. And a big thank you to the entire Ever.Ag Insights team for making the show a reality. Until next time, stay safe and pray for rain.